Thinking about investing in 2026, but don't know where to start? Forget trying to pick the next hot stock. What if I told you there's a simple, proven way to build wealth that millions of Americans have used for decades? A method so straightforward it requires almost no effort. You don't need to predict the future. You don't need a fancy finance degree. You just need to own the market cheaply and consistently. In this video, I'm breaking down the top 5 index funds every beginner in the US should consider right now. And I'll show you how you can get started with as little as $100. Let's dive in. So, what exactly is an index fund? It's way simpler than it sounds. An index fund is a type of investment that holds a collection of stocks designed to mirror a specific market index, like the famous S&P 500 or even the entire US stock market. Instead of paying a professional to try and beat the market by picking individual winners and losers, which most of them fail to do, by the way, an index fund just aims to match the market's performance. So why does that matter for you? Well, let's look at the historical numbers. Over the long haul, the US stock market has delivered average annual returns of about 10 to 11% before inflation. After you account for inflation, that's historically been around 7%. Now, compare that to today's inflation rate, which hovers around 2 or 3%, and then look at your savings account, which probably pays you even less than that. Your money in a savings account is actually losing its purchasing power over time. Investing in the market gives you a chance to outpace inflation and actually grow your wealth. The other huge advantage of index funds is their incredibly low cost. Most actively managed funds, where a manager is picking stocks, will charge you an annual fee called an expense ratio of anywhere from 0.5% to over 1%. That might not sound like much, but it adds up. The index funds we're talking about today have expense ratios between 0 and just 0.04%. Over your lifetime, that tiny difference in fees can compound into tens or even hundreds of thousands of dollars more in your pocket. That's why long-term, passive index investing is the champion for most people, and it's the perfect strategy for beginners. All right, let's get to the main event. The countdown of the top 5 index funds for beginners in 2026. Coming in at number 5 is the Schwab US Broad Market ETF, ticker symbol SCHB. This fund has an ultra-low expense ratio of just 0.03%. It's designed to track the entire US stock market, meaning you own a piece of large, medium, and small American companies all in one go. Beginners love it because it provides massive diversification with just a single purchase. It's widely available at most brokerages, so you don't need a Schwab account to buy it. The pros are its broad exposure and strong long-term returns, which are very similar to the S&P 500. The only slight con for a total newbie is that since it's ETF or exchange-traded fund, the process of buying shares can feel a little different than buying a traditional mutual fund, but it's really simple once you do it once. Overall, SCHB is a fantastic set-it-and-forget-it fund for building a core U.S. stock portfolio. Next up, at number 4, we have the iShares Core S&P Total U.S. Stock Market ETF. Ticker ETOT, just like our number 5 pick. This fund also has a rock-bottom expense ratio of 0.03%. And as its name suggests, it also aims to give you ownership across the entire U.S. stock market. So why choose this one? iShares is a brand run by BlackRock, one of the largest asset managers in the world, making ITOT incredibly reliable and easy to trade. The pros are that its performance is nearly identical to its Vanguard and Schwab competitors, and it works seamlessly at almost any brokerage you choose. The only con, similar to SCHB, is that it's focused only on US stocks, so you don't get international exposure. But for a simple, cheap, and widely trusted way to own the US market, ITOT is a fantastic choice. Cracking our top 3 is a true classic, the Vanguard Total Stock Market Index Fund, ticker VTSAX. This fund has a tiny expense ratio of 0.04%. VTSAX is the original Boglehead fund, named after Vanguard's founder Jack Bogle, who pioneered low-cost index investing. It owns a piece of nearly every publicly traded stock in the United States, from Apple and Microsoft all the way down to the smallest companies. The biggest pros are its decades-long track record of success and its extreme efficiency with low costs and low turnover. The main drawback for brand new investors, however, is its $3,000 minimum initial investment. If you have that cash ready to go, VTSAX is considered the gold standard for long-term U.S. market exposure. It's a mutual fund, so you can easily set up automatic investments, which is a huge plus. In the number 2 spot, we have a game changer for new investors, the Fidelity Zero Total Market Index Fund. Ticker FZROX. What makes this one so special? The expense ratio is literally zero. That's right, 0.00%. There's no management fee. Plus, it has a minimum investment of $0, so you can start with any amount you want. You buy it in dollar amounts, not shares, which is super intuitive for beginners. The pros are obvious. Free exposure to the entire US market. It's a perfect fund for opening a Roth IRA at Fidelity. But there are a couple of key cons. First, it's only available if you have a Fidelity account. And second, because it's a proprietary fund, you can't transfer it in kind to another brokerage like Vanguard or Schwab if you ever decide to switch. You'd have to sell it, which could trigger taxes, and then rebuy something else. But if you're a Fidelity customer, FZROX is arguably the cheapest and easiest way to start investing in the US stock market. And finally, our number 1 index fund every beginner should consider in 2026 is the Vanguard S&P 500 ETF, ticker VU. With an expense ratio of just 0.03%, this fund tracks the S&P 500 index. So why is this number 1? While the total market funds are great, the S&P 500 is simpler to understand. It represents the 500 largest and most established companies in the US. These companies make up about 80% of the entire US stock market's value anyway, so you're still getting massive diversification. The pros are its simplicity, its huge scale and liquidity, and its historically strong returns. It's the benchmark that everyone compares themselves to. The main con is that you're missing out on the potential growth from smaller US companies, and you get no international stocks. But honestly, if someone came up to me and said, "I have $100, just tell me one thing to buy, and I'll start right now," VU is almost always the answer. It's simple, it's effective, and it's a perfect first step into the world of investing. So, how do you actually get started? It's so much easier than most people think. First, you need to open a brokerage account. Beginner-friendly platforms like Vanguard, Fidelity, and Charles Schwab are all excellent choices. You can open an account online in just a few minutes. Once your account is open and funded, you simply search for the ticker symbol of the fund you chose, like VOO or FCROX, and place a buy order. My key tip for beginners is to use a strategy called dollar cost averaging. This just means you invest a fixed amount of money on a regular schedule, like $100 every single month, no matter what the market is doing. This strategy removes emotion from the equation and builds an incredibly powerful wealth-building habit over time. You don't need to be an expert to build wealth. You don't need to time the market perfectly. You just need to start. Pick one of these simple, low-cost index funds, open your account, and invest your first $100 this week. Then stay consistent and let time and compounding do the heavy lifting for you. If you found this helpful and want more beginner-friendly guides to investing and managing your money in 2026, make sure you subscribe to WealthForge USA for more videos just like this one. Thanks for watching.